If you plot the estimated existence of our species onto a single day, then the stock market, as we know it today, would appear somewhere around 6 seconds before midnight. No wonder that we find it so difficult not to sell our whole portfolio when there's a market crash. No wonder we participate in periods of buying madness, even though valuations of companies have risen to the sky. And no wonder we find it hard to stick to our investing plans when our friends are getting rich with other strategies. We make big mistakes in the markets simply because we're not genetically coded for this stuff. But we're in good company. Even though investing superstars like Warren Buffett, Bill Ackman, Stanley Druckenmiller, and Benjamin Graham sometimes may look like they're from a different species because of their abnormal successes in the stock market, they too have faced the same problems that you and I are facing today. They too have made big mistakes in the stock market. So in this video, you'll be learning about some of the biggest mistakes by 4 investing legends. The purpose of sharing this is partly so that you may be able to avoid doing these mistakes in your own portfolio, but primarily to show that mistakes are just a part of the game. Warren Buffett, Bill Ackman, Stanley Druckenmiller, and Benjamin Graham were able to achieve astonishing market returns over time by learning from these experiences and by not losing sight of their long-term goals because of occasional mess-ups. This is a top 4 takeaway summary of big mistakes written by Michael Batnick. And this is Nasdaq with Arshia, giving you the tips and tools you need to reach financial success through stock investing. Takeaway number 1, Warren Buffett and the availability heuristic. Warren Buffett is arguably the greatest investor of all time. Together with his right-hand man, Charlie Munger, he has created the largest conglomerate in the entire world, Berkshire Hathaway. They've accomplished this by investing successfully in companies for many decades now, but even legends such as Buffett has occasional hiccups. In 1991, Warren Buffett acquired the shoe company H.H. Brown through his Berkshire Hathaway company. H.H. Brown proved to be a tremendous investing success. In 1992, Buffett bought another shoe company called Lowell Shoe. Again, the success was pretty much immediate. Therefore, it didn't come as a surprise that in 1993, Berkshire announced the acquisition of a third company in the same industry, Dexter Shoe. Only this time, Buffett fell for one of the most dangerous human biases when it comes to investing, the availability heuristic. The availability heuristic is a mental shortcut that relies on immediate examples to come to a given person's mind when evaluating a specific topic, concept, method, or decision. Warren Buffett saw a company within an industry that he had been successful in on multiple occasions previously, that had a fine top management, and that could be acquired at a fair price. No wonder this seemed to make sense to buy. The only problem was that Dexter Shoe wasn't H.H. Brown Shoe or even Lowell Shoe. It just appeared to be in a similar situation, and the examples were readily available in Buffett's mind. The difference was that Dexter's shoe didn't have the same type of moat around his business as the other two, and because of this, it got crushed by low-priced competitors from countries like China. Just 6 years later, Berkshire Hathaway decided to write down all of the goodwill from the acquisition, basically deeming the business of Dexter's shoe worthless. What's the lesson here? Be extra careful when you invest in a company that appears to be similar to a previously successful investment that you've made. Takeaway number 2, Bill Ackman and ego. Bill Ackman is one of the most famous and successful activist investors ever. An activist is an investor that uses his equity to take a stake in a company to put pressure on the management in a certain direction. A typical situation would be where a company sits on a lot of assets, but it is a failing business. An activist could pressure the company to sell off its assets so the shareholders can cash out instead of keeping on throwing good money after bad. In 2012, Bill Ackman started to publicly criticize a company called Herbalife. He claimed that the company was basically a pyramid scheme and announced that his hedge fund, Pershing Square Capital Management, sold the company short, meaning that he was betting that the stock would crash. Ackman seemed convinced. In 2013, he was on Bloomberg television and stated that his short position was between 400 million and 500 million in the red, but that he would hold on to his position to the end of the earth. In 2018, Ackman finally exited his bet against Herbalife at an undisclosed loss. The mistake that Bill Ackman committed is in many ways similar to that of Mark Twain, president before. Because Ackman had gone out and expressed such strong views about Herbalife, it became increasingly more difficult for him to back down. Even though evidence that contradicted Ackman's theory kept coming, he would have none of it. What's the lesson? We shall never forget that the purpose of investing is to make money, not to be proven right. Therefore, one must be very careful about expressing opinions about stock market investments. It could create a situation where ego gets in the way of making the correct financial decision. Takeaway number 3, Benjamin Graham and leverage. Ah, yes. Even the great Benjamin Graham, the father of value investing, made mistakes at times. Benjamin Graham is probably most famous for writing the book The Intelligent Investor and for being the teacher of previously mentioned legendary Warren Buffett. If you want to hear more about Benjamin Graham, I will upload a video soon on his subject. Now on to his mistake. Just before the Great Depression, Graham decided to put up all his money and then some. In 1929, the Dow Jones fell and Graham's portfolio fell with it. Therefore, in 1930, Graham reasoned that stocks must currently be cheap, so he decided to leverage his portfolio and go even more than all in. In 3 years, he had wiped out 70% of his investing account. The takeaway here is that no investment style is immune to short-term fluctuations in the market. Not even that of the legendary Ben Graham. The lesson should be that the investor must construct a portfolio so that he captures enough of this upside in the bull market as to not feeling left behind, and so that he survives a bear market where everyone around him loses their minds. Takeaway number 4, Stanley Druckenmiller and investing that fits. Stanley Druckenmiller is one of the most successful macro investors of all time. And in between 1981 to 2010, investors in this hedge fund received an annual return of approximately 30%. Yes, 30%. This is an investing record that not many could surpass. Moreover, Druckenmiller was the head of George Soros' quantum fund between 1988 and 2000. But even Stanley Druckenmiller made his share of investing mistakes. Druckenmiller produced his abnormal investing track record primarily by taking a macro approach and betting on stocks, bonds, and currencies. Famously, he and Soros broke the Bank of England in 1992 when they shorted the British pound and earned $1 billion on that single trade. But in the midst of the dot-com bubble, he went astray and got involved in tech stocks. Reportedly, he bought stocks for $6 billion in 1 week, and 6 weeks later, he had lost 3 of those billions. The mistake is clear. One should not venture too far out into the unknown. You must stay within your circle of competence and find an investing style that fits. Druckenmiller was an expert macro investor, but he didn't know much about tech. Because people were making so much money in tech at that time, he couldn't resist the urge to try it himself. There will be times when your style of investing is out of favor, when others are making more money than you are, but that is just part of the game. Always remember. And that's it. Remember, the great learn and grow from their mistakes. Normal people are set back by them. If you want to learn